Do you think you are a good driver? Or let me rephrase that question. Do you think you're relatively better than the average Joe? Well, if you answered yes, you're not alone in thinking that way. Over 70% of all drivers believe they're better than average. Realistically, however, that isn't a tenable proposition. And that can only mean one thing. People like to overestimate their abilities, even when they may not be fully competent. In fact, this kind of overconfidence even has a special name. It's often called overplacement, or the Dunning-Kruger effect. If you really wanted to know who's a better driver, you'd get a pretty good answer if you were to simply compare insurance premiums. The insurance regulator have recently decided to let general insurance companies create and sell pay how you drive policies. Meaning your premiums will depend on your driving behavior. That is, if you're speeding, cutting lanes, accelerating and decelerating quickly, you'd have to shell a higher premium. And if you exhibit exemplary driving traits, you may be asked to pay a lower sum. The insurance company may ask you to install a tiny GPS-like device or sensor to track your driving behavior. And then they will determine the risk you pose to yourself and others on the road. If you pose a lower risk than the average driver, well, you pay a lower premium and vice versa. The insurance companies could even monitor your driving patterns and offer meaningful suggestions on how to improve. But the innovations don't stop there. Remember how during the lockdown of 2020, many insurance companies refunded a portion of their premiums because people weren't commuting as much? Well, it seems there is an attempt to institutionalize this idea too. By offering pay-as-you-go motor insurance policies. All you have to do is simply declare the number of kilometers you'll potentially drive in a year and pay the premium according to usage. In many ways, this is a far cry from how cars and two-wheeler insurance policies are priced. Typically, the insurance companies will price a policy based on insured declared value. Insured declared value is the maximum amount of money that the insurer will pay in case of theft or a loss. And if the insured declared value were higher, you'd have to pay a higher premium. However, in this system, driving patterns and total distance traveled aren't taken into account. So in some ways, it isn't exactly a fair program. Here, safe drivers, or people who don't drive as much, end up subsidizing the riskier individuals. They pay a higher premium even though they aren't the ones making most claims. But if pay-as-you-go and pay-as-you-drive policies go mainstream, then insurance will become a more equitable enterprise.